What if the biggest risk to your silver investment isn't the price of silver at all? What if the real source of is unfolding behind the scenes in liquidity, institutional positioning, and the global financial system? Most investors are watching charts. Smart capital is watching capital flows. The next few days could reveal whether recent market moves are simply volatility or the beginning of a much larger shift. If you own silver or you're thinking about buying it, you need to understand what the market is actually signaling before you make your next decision. Stay with me because the facts matter far more than the headlines. Most investors believe the story begins and ends with the silver price. They wake up, check the chart, compare today's number with yesterday's, and assume that tells them everything they need to know. It doesn't. Price is only the final result of forces that have been building long before the market opens. By the time everyone notices a sharp move, the important decisions have already been made behind closed doors by institutions managing billions of dollars. Markets are not driven by excitement, they are driven by liquidity. Liquidity is the ability of money to move freely through the financial system. When liquidity is abundant, investors are comfortable taking risk, credit is available, borrowing costs remain manageable, and capital flows into stocks, commodities, and other assets. But when liquidity begins to tighten, everything changes. Institutions stop asking how much they can make and start asking how much they can lose. That shift in thinking is often invisible to the average investor. There is no flashing warning sign announcing that large funds are becoming more defensive. There is no headline that says capital preservation has become the priority. Instead, the clues appear in funding markets, bond yields, lending conditions, and the behavior of sophisticated investors. These signals rarely dominate financial television because they are less exciting than dramatic price charts. Yet they are often far more important. Silver sits at an interesting intersection of the global economy. It is both a precious metal and an industrial resource. That means its value is influenced by investment demand as well as expectations for manufacturing, technology, energy, and economic growth. Because of this dual role, silver can react quickly when markets begin reassessing economic conditions. But those reactions are usually a consequence of changing financial conditions rather than the cause. Professional investors understand this distinction. They don't begin with the metal, they begin with the system. They study whether banks are lending more cautiously, whether businesses are delaying investments, whether borrowing costs are changing corporate behavior, and whether consumers are becoming more selective with spending. Those factors eventually influence commodity demand, investor sentiment, and asset allocation. This is why periods of elevated volatility deserve careful analysis instead of emotional responses. Sharp price swings attract attention, but volatility alone does not define opportunity or danger. Sometimes markets experience dramatic movements simply because liquidity becomes thinner. When fewer buyers and sellers are willing to transact at the same time, relatively small changes in order flow can produce outsized price movements. Investors who mistake every volatile session for a permanent trend often find themselves buying high or selling low. Institutional investors recognize another important reality. Markets are interconnected. Decisions made in one corner of the financial system rarely stay isolated. A shift in interest rate expectations can influence government bonds. Bond markets can affect currencies. Currency movements can influence commodities. Credit conditions can reshape corporate investment decisions. Before long, what appeared to be a single market event becomes a broader financial adjustment. That is why experienced capital allocators spend more time studying relationships than headlines. They understand that today's market environment is shaped by thousands of interconnected decisions made across banks, corporations, governments, and investment firms. Looking at only one asset in isolation rarely provides the complete picture. Another mistake individual investors make is assuming institutions react emotionally to breaking news. In reality, large organizations operate through disciplined risk management frameworks. Portfolio managers continuously monitor exposure, stress test assumptions, and prepare contingency plans for multiple scenarios. Their objective is not to predict every market move perfectly. Their objective is to remain resilient regardless of which scenario unfolds. That mindset offers an important lesson. Investing should not revolve around predicting tomorrow's headline. It should revolve around building a portfolio capable of navigating uncertainty. Financial history repeatedly demonstrates that unexpected events occur with remarkable regularity. Markets surprise investors because the future is never fully knowable. The investors who endure are not necessarily the ones with the best forecasts. They are the ones whose strategies remain durable when forecasts prove wrong. When liquidity conditions begin shifting, disciplined investors resist the temptation to chase every price movement. Instead, they ask practical questions. Has the long-term investment thesis actually changed? Has the broader economic outlook materially shifted? Are current prices reflecting emotion or fundamentals? Is the market offering risk or opportunity? These questions produce better decisions than reacting to every headline that appears during a volatile week. Financial markets reward patience more often than urgency. Acting simply because a countdown exists or because others appear anxious rarely leads to consistent success. Time pressure can cloud judgment, causing investors to confuse activity with progress. Sometimes the smartest decision is to gather additional information before making meaningful portfolio changes. This is especially true during periods when uncertainty dominates market sentiment. Uncertainty is uncomfortable, but it is also the environment where disciplined investing becomes most valuable. Investors who remain calm, maintain liquidity, diversify appropriately, and evaluate risk objectively often place themselves in stronger positions than those who constantly chase the latest narrative. Ultimately, the most important clock is not measuring the future direction of silver alone. It is measuring how financial conditions evolve beneath the surface of the global economy. Markets are constantly transmitting information through liquidity, credit, capital flows, and institutional behavior. Those signals deserve far more attention than daily price fluctuations. Investors who learn to recognize them gain something far more valuable than a prediction. They gain perspective, and perspective is often the difference between reacting to markets and understanding them. When markets become fixated on a single asset, they often overlook the broader forces that are actually driving its movement. It is tempting to believe that every rise or decline in silver tells its own story, but markets rarely work that way. Individual assets are usually responding to something much larger happening beneath the surface. The real signal often comes from the economy itself, its strength, its weaknesses, and the expectations investors have about where it is heading. Those who understand the macroeconomic environment are often far better positioned than those who focus exclusively on commodity prices. Every investment exists within a larger financial ecosystem. Businesses make hiring decisions based on demand. Consumers are just spending based on confidence and income. Banks evaluate lending risk according to economic conditions. Governments implement fiscal policies in response to growth or contraction. Central banks assess inflation, employment, and financial stability before making policy decisions. Each of these moving parts influences capital flows across the global economy, and eventually those flows shape the behavior of financial markets. Inflation remains one of the most closely watched indicators because it affects nearly every asset class. When inflation accelerates, purchasing power declines, businesses face higher operating costs, and policymakers often respond by maintaining tighter financial conditions. When inflation moderates, markets begin reassessing future borrowing costs and economic growth expectations. Investors who understand these relationships recognize that inflation is not simply an economic statistic. It is a signal that influences how money moves across the financial system. Interest rates play an equally important role. The cost of borrowing affects consumers purchasing homes, companies financing expansion, and governments managing debt. Higher borrowing costs tend to slow economic activity because financing becomes more expensive. Lower borrowing costs generally encourage investment and spending. Financial markets constantly evaluate where interest rates may move next because those expectations influence everything from stock valuations to bond prices and commodity demand. Economic growth also deserves careful attention. Strong growth usually supports industrial activity, infrastructure investment, manufacturing output, and technological development. Slower growth often leads businesses to postpone expansion plans, reduce capital expenditures, and become more selective with hiring. Since industrial demand represents an important component of many commodity markets, economic momentum frequently has a greater long-term impact than short-term market speculation. This is why experienced investors spend significant time studying economic data rather than reacting to daily price movements. Employment reports, manufacturing activity, consumer confidence, retail spending, business investment, productivity, and credit conditions each provide valuable insights into where the economy may be heading. None of these indicators offer certainty on its own, but together they create a clearer picture of financial conditions. Markets are forward-looking. Prices today often reflect expectations about tomorrow, rather than current conditions alone. Investors continually attempt to anticipate how economies will evolve over the coming months and years. That explains why markets sometimes rise during weak economic data or decline despite seemingly positive headlines. Expectations matter as much as reality because capital is always looking ahead. Government debt has also become an increasingly important factor in long-term economic discussions. Rising debt levels influence fiscal flexibility, borrowing requirements, and investor confidence. While economies can sustain significant debt for extended periods, larger debt burdens often require careful policy decisions to maintain financial stability. Investors monitor these developments because government finances affect bond markets, interest rates, currency valuations, and broader market confidence. Global supply chains continue to shape economic outcomes as well. Manufacturing disruptions, transportation bottlenecks, geopolitical tensions, and changes in international trade can all influence production costs and business profitability.
How modern economies are deeply interconnected. A disruption in one region can quickly affect companies and consumers across multiple continents. Markets respond not only to current disruptions, but also to expectations regarding how long those disruptions may persist. Another important factor is
business confidence. Corporate leaders constantly evaluate future demand before making major investment decisions. When executives feel confident, they hire employees, expand facilities, invest in technology, and pursue growth opportunities. When uncertainty increases, businesses often preserve cash, delay expansion, and focus more heavily on efficiency. Those collective decisions influence employment, income growth, and overall economic momentum. Consumer behavior remains equally significant. Household spending represents a substantial portion of economic activity in many countries. When consumers feel financially secure, spending generally supports business revenues and economic expansion. When uncertainty rises, households often prioritize savings, reduce discretionary purchases, and become more cautious with major financial commitments. These behavioral shifts gradually ripple throughout the economy. Institutional investors understand that successful investing requires seeing these connections rather than viewing each market independently. They evaluate how monetary policy influences credit, how credit influences business investment, how investment affects employment, and how employment supports consumer demand. Markets are complex systems where one development frequently influences another. This perspective encourages patience during periods of heightened volatility. Rather than interpreting every sharp market movement as a permanent trend, disciplined investors ask whether the underlying economic fundamentals have materially changed. Temporary market noise often fades. Structural economic changes tend to have longer-lasting consequences. Risk management becomes especially valuable during uncertain economic periods. Diversification, maintaining appropriate liquidity, and avoiding excessive leverage help investors remain flexible regardless of how conditions evolve. Financial history repeatedly demonstrates that unexpected developments occur even when economic forecasts appear highly confident. Preparing for multiple outcomes is generally more effective than relying on a single prediction. Ultimately, the most valuable information rarely comes from the daily movement of one commodity. It comes from understanding the broader economic forces shaping the global financial system. Inflation, interest rates, business investment, government policy, consumer confidence, credit conditions, and global growth collectively provide a more reliable framework for evaluating long-term opportunities. Investors who concentrate on these underlying drivers are often better equipped to separate temporary market distractions from meaningful structural changes. In investing, lasting success is rarely determined by following the loudest headline. It is built by understanding the economic foundation beneath every market movement and making decisions based on disciplined analysis rather than short-term emotion. One of the most common mistakes investors make is believing that financial success belongs to those who can accurately predict what will happen next. Every year, countless forecasts attempt to identify where markets will finish, where interest rates will move, how fast economies will grow, or which asset will outperform. Some of those predictions eventually prove correct, but often by coincidence rather than certainty. The reality is that even the most experienced professionals cannot consistently forecast every market movement. Markets are influenced by millions of individual decisions, unexpected events, technological change, policy shifts, geopolitical developments, and evolving investor psychology. No forecast can perfectly account for all of those variables. Successful investing has never been about possessing perfect foresight. It has always been about preparing for multiple possible outcomes. That distinction may seem subtle, but it changes the entire approach to managing wealth. Preparation acknowledges uncertainty instead of fighting it. Rather than asking what will definitely happen, disciplined investors ask what could happen and whether their portfolios are resilient enough to withstand different scenarios. Financial history offers countless reminders that uncertainty is permanent. Economic expansions eventually slow. Recessions eventually recover. Inflation rises and falls. Interest rates move through cycles. Markets experience periods of optimism followed by periods of caution. None of these developments occur on perfectly predictable schedules, yet every one of them has repeated throughout modern financial history. Investors who understand the cyclical nature recognize that flexibility is often more valuable than certainty. Preparation begins with risk management. Many people think risk management means avoiding risk altogether, but that is not the objective. Every investment carries some level of uncertainty. The goal is to understand those risks, measure them realistically, and ensure that no single event can permanently damage long-term financial goals. Institutions devote enormous resources to this process because preserving capital provides the opportunity to continue investing through changing market environments. Diversification remains one of the most effective forms of preparation. Different assets respond differently to changing economic conditions. Some perform better during periods of economic expansion, while others provide stability during uncertainty. A diversified portfolio does not eliminate volatility, but it reduces dependence on any single outcome. That balance allows investors to remain engaged in the market without exposing themselves to unnecessary concentration risk. Liquidity is another essential element that often receives too little attention during strong markets. When conditions appear favorable, investors sometimes commit every available dollar to investments with little regard for flexibility. Yet financial opportunities frequently emerge during periods of uncertainty. Investors who maintain sufficient liquidity are often able to respond thoughtfully when markets present attractive valuations. Those who have exhausted their financial flexibility may be forced to watch opportunities pass by. Patience also represents a form of preparation. Financial markets reward long-term discipline more consistently than short-term reaction. During periods of heightened volatility, emotional decision-making becomes increasingly expensive. Fear encourages investors to abandon sound strategies after prices decline. Excessive optimism encourages them to chase assets after prices have already risen significantly. Neither behavior reflects disciplined preparation. Instead, successful investors establish clear principles before volatility arrives, making it easier to remain consistent when emotions intensify. Professional capital allocators rarely rely on a single economic forecast. Instead, they develop multiple scenarios. They consider what happens if growth accelerates, if inflation remains elevated, if borrowing costs stay higher than expected, or if economic conditions weaken unexpectedly. Each scenario receives careful evaluation, allowing portfolios to remain adaptable regardless of which path ultimately develops. This approach recognizes that uncertainty cannot be eliminated, only managed intelligently. Another important aspect of preparation involves continuously reassessing assumptions. Markets evolve, technologies reshape industries, consumer preferences change, regulatory environments shift, competitive landscapes transform over time. Investors who periodically evaluate whether their original investment thesis still holds are generally better positioned than those who simply hope conditions remain unchanged. Flexibility does not mean abandoning long-term conviction. It means remaining intellectually honest as new information becomes available. One of the greatest competitive advantages in investing is emotional discipline. Markets often encourage impulsive behavior because financial headlines amplify urgency. Every significant market movement appears to demand immediate action. Yet history repeatedly demonstrates that many of the strongest investment decisions are made by those willing to remain calm while others become emotional. Emotional stability allows investors to evaluate facts objectively, rather than reacting to temporary sentiment. Preparation also extends beyond portfolios themselves. Personal financial strength matters just as much as investment selection. Maintaining manageable debt, preserving emergency savings, controlling unnecessary expenses, and aligning investments with long-term objectives all contribute to financial resilience. Wealth is not created solely through market performance. It is strengthened by consistent financial habits that provide stability regardless of economic conditions. Long-term investing requires humility. Every investor will occasionally make mistakes. Every portfolio will experience periods of underperformance. Every economic cycle presents unexpected developments. Preparation acknowledges these realities rather than assuming perfection. Investors who remain open to learning, adapting, and improving their decision-making process often outperform those who become overly confident after periods of success. The most successful investors understand that protecting capital during difficult periods is just as important as generating returns during favorable ones. Recovering from large loss requires significantly greater future gains, making downside protection an essential component of long-term wealth creation. This perspective shifts the focus away from maximizing returns in every environment toward achieving sustainable progress across many different market cycles. Financial success rarely depends on making one extraordinary prediction. More often, it results from consistently making thoughtful decisions over many years. Small advantages accumulate, disciplined habits compound, rational decision-making strengthens resilience, patience allows investments time to grow. These qualities may appear less exciting than bold forecasts, but they have repeatedly proven more reliable over the long run. Ultimately, enduring wealth is built through preparation because preparation creates resilience. Markets will continue changing. Economies will continue evolving. Unexpected events will continue testing investor confidence. Those realities are unavoidable. What remains within every investor's control is the quality of their planning, the discipline of their decision-making, and their commitment to managing risk with patience and perspective. Investors who embrace that mindset position themselves not merely to survive uncertainty, but to recognize opportunity when others are distracted by short-term predictions.